with the focus for that meeting was digital service tax. But for today, we will be looking at how you file your returns, and so on. And as I said, this is really part of the work that we are doing. Next week, we will also be engaging on intellectual property rights, again working close with Kekobo, and we are also engaged in other matters related to repatriation of cultural heritage that belongs to Africa, that is located in Europe as well as the United States. So we are trying to do our best in terms of really contributing to the growth of the sector, and also for the sector to fulfill its obligations. The decision to discuss taxation results from conversations we have had within the sector, because we work in the sector, in which most of the creatives complained that they would like to be able to file their returns, but they do not know how to go about it. And of course, when the sector says that, our role really is to find out how best to help them do what they would like to do. And therefore, today we have an immense privilege to work with a tax expert who will be taking us through the ideas on taxation filing. And the gentleman that will be taking us through is Evans Kithinji, who is a tax consultant at Gilded and Bright Africa Limited. He has worked really broadly within not just the creative sector, but also other sectors in Kenya. He has done quite a bit of work on withholding tax, VAT, pay-as-you-earn, corporation tax, tax planning and restructuring. And he's very equipped to work with us today to reflect a little more on how this creative sector can file their returns. I mean, of particular interest to me is what type of exemptions, for example, the sector might have, as well as how they can, minimize the overtaxation in situations where they pay tax where they should not actually be paying tax. And I'm not even sure that such situations exist in this country, where when the taxman is really looking deeply into the pockets. So I want to welcome Evans to share with us his presentation. And then after he has finalized his presentation, he will be able to interact with us in a question and answer session. We will try to keep the session focused on those issues, so that we are in a good place at the end of it all. So Evans, welcome. Take us through, and we will be expecting more people to join, but we also know that this hour is also a very intense hour for meetings. So we will work with the number that we have. So Evans, karibu sana.
Thank you very much, Professor Kimani and Jogu. It's a privilege to be able to work with you, to be able to achieve the goals, especially for the sector. And I hope that through our actions today, we'll be able to impact the sector greatly. Good morning, class, if you'll allow me to say that. It's a privilege also to be able to take you through taxation today. I can't labor so much beyond this point in terms of introduction. A lot has been said already, and I really appreciate. Now, maybe we could, because of the limited amount of time we have, quickly kick into our discussion today, taxation. and our emphasis is on filing returns. And so as we discuss this, you'll get to see that some of the things that you thought were so obvious may not be as obvious as you thought before. Probably by the end of the class, you'll get clarification and all that. Clarification and the way forward. So feel free to write in your questions on the chat, and then we'll be able to take them after. So I'd like to kick off very quickly by discussing taxation in Kenya and the applicable taxes. Now in Kenya, taxes are usually computed in two main ways. So there are those taxes which are computed directly from income, and there are those ones which are indirect. Now, direct taxes would be the tax from the profit you get, maybe from a business or as an individual or from employment. And you'll find that this affects your bottom line. It affects the amount of money you have in your pocket. So you'll find that ultimately, okay, all taxes affect the amount of money you have in your pocket, but it greatly affects your income. So you have agreed on an assignment, you've agreed the amount, and from the amount, that income, then there is a tax to be paid. So you find that those taxes are in nature called direct taxes. And for example, part of the direct taxes that are applicable will be income tax, will be pay as you earn. There will be some form of advanced taxes, which include withholding tax and installment taxes. Now, these taxes greatly affect both individuals and limited companies. But you'll find that for companies, then the rate of tax would be straight 30%, whereas for individuals, then and partners and sole proprietorships, then the taxes would be staggered. And by staggering, it means that it will be the pay as you earn, where now there are some brackets which are used to apply to determine how much tax is payable. Okay, now that's with regards to direct taxes. When we're discussing about indirect taxes, then we have got taxes that do not necessarily relate to the income you have generated, but they are levied as a result of you participating in an activity or a particular transaction. So I'll give an example. When you import your car, you are probably using your savings or money you borrowed from the bank. You've not made an income. Or even if you made income, it has been taxed, and therefore this is generally what you have kept aside for yourself as either your savings, and therefore the activity or the transaction where you're buying the car, there is no revenue you generate. You actually are spending money. So you get money which you will pay to the owner of the car, who will then ship the vehicle to you. However, when the car gets to the port of Mombasa, or to JKIA for that matter, then you find that at that point, then there's a requirement for you to pay taxes. Now, the taxes that you are paying at this point are what we call indirect taxes. So you'll find that you'll have to pay import duty, you'll pay excise tax, and you will pay VAT. These taxes are levied because you have participated in this transaction. A similar scenario would be in a case where we are discussing about manufacturing. So VAT or like for instance, maybe VAT or an individual who bottles water will have to pay excise tax. This tax is not because you have sold and made a profit, it is because you have taken or participated in the generation or in a particular activity. Now, what usually happens is this: most of the taxes are usually geared towards something. So excise taxes are usually geared towards preventing people from participating in certain activities. So you'll find alcohol will have excess tax, cigarette will have excess tax, you'll have bottled water, you'll have bank transactions having excess tax, all in a bid to prevent these institutions, either for financial institutions, prevent them from charging these fees. For the manufacturing companies, maybe for alcohol and cigarette, to prevent and make the product more expensive so that a consumption of alcohol and on cigarettes is kept at a minimum. However, we've seen it may not necessarily have the desired results because it either pushes people to consume cheap unadulterated liquor or and such like things, which then have got an even worse impact, or the cost is actually just transferred to the end consumer and they continue to spend and consume the same products. Import duty is designed to protect local markets, the nascent markets. So you'll find where the production, where you're bringing, for instance, raw materials to be used in manufacturing locally, then the rate of import duty will be lower as to a situation where you're bringing in a finished good. So for instance, if you bring in rubber, which you're going to convert and make tires, you'll find that the rate of duty might be lower as compared to when you actually import a complete, fully manufactured, fully functional tire. All right. VAT is levied. Ideally, from the name, you'd expect there's an aspect of value addition, but it's not always the case. There are cases where there's minimal value addition. And so generally, it's in an effort by the government to levy on tax and probably generate income to run its activities. Now, you'll find that the government will levy taxes. Okay, and maybe this will answer the question why we need to pay tax. The government prepares a budget. So for instance, in the financial year 2021-2022, there's a budget in place. However, the government doesn't have the revenue as yet. And so the money comes from the taxes that they collect. And that's why you find after a while, they become more and more aggressive because they have got a target which they need to meet, which was set in the budget. So they have to always work hard to make sure that they meet the set target. And so you find that in that case, then that explains taxes. Now, taxes are important because you cannot offer all the services probably you may need. And since through the constitution, we have already delegated some responsibility to the government, then the government coordinates certain functions and certain services. So it coordinates and offers functions like for security. So all the security, so from the police to the army, special ops, apart from probably private security, the guards who look after us and take care of us. Now, you'll find that the government, we cannot be able to offer that kind of security. It has to be offered in a controlled space and a controlled environment. And therefore, the taxes that we pay go and facilitate those projects. Same thing to roads. If we were to try and construct roads, definitely we'll have an issue because we have got different needs. One is driving a Mercedes, one is driving a motorbike or a bicycle. The needs for roads are different. But then when we have paid taxes, then the government is able to offer a service, then we all can be able to enjoy. So that explains taxes, and that also explains how the taxes are levied in Kenya. So the purpose of this class probably would be primarily to help you to understand and how to file returns. But before we discuss how to file returns, we must be able to identify the income, and secondly, to be able to compute taxes. After we're able to compute taxes, then we can be able to file returns. Now, for the first two sections, which ideally is identifying income and computing taxes, you may not get into too much of the detail. But I'll give you some of the most important things that you need to be aware about and the things that you need to do. However, our emphasis will be more in or towards the end, what is required of you when you're filing the returns. So on to the very first thing, first part of our objective today is to understand what income is taxable. Now, from the Income Tax Act, which governs the taxation of income in Kenya, find that the requirement is that all income of a person, resident or non-resident, which is accrued in or was derived in Kenya, is subject to income tax in Kenya. This simply means that for purposes of tax, it does not matter the source of your income, as long as it is an income. Then, that being the priority, one of the priorities, that it is an income which has been accrued to you, whether you got the income legitimately or illegitimately. There are instances where you had people who have raised invoices and they've done work and they've been paid. That's legitimate business. And you've heard of the wash business. When it comes to taxation, they don't look at the source. They look at the fact that it is an income to you. The second thing that is very important is that this income is actually paid to a person. Now, the person is either the physical person, the individual, in this case, for instance, Evans, or the person created, the artificial person created by law. So you could find in an instant either a company or partnership. So you'll find that in many cases, when you're discussing about the person, they use it in a very broad sense. Now, the other question that becomes very important is a question of residency. When it says all income of a person, either resident or non-resident, that means whether you're staying in Kenya or you're here for a short time frame. Then, in as long as the income was generated and accrued in Kenya, then it becomes taxable in Kenya. So one of the most important things you also need to understand is a question of resident. When are you a resident of a jurisdiction? Now, in the Kenyan law, when you're discussing residence, that means the time frame, they use a time frame you spent in Kenya as a basis. So for instance, for you to be considered to be a resident of Kenya, you must have been in Kenya for a period more than 6 months in 1 year. So if you've been in Kenya from January until June, then for tax purposes, you're resident in Kenya. Or if you have been in Kenya for an average of 3 months in 3 years. So 3 months each year in the 3 years. So in short, it's 121 days in a period of 3 years. Then you're considered to be resident in Kenya. And so all the income that you will accrue will be taxable in Kenya. There are instances where you're non-resident. So especially in the creative space, you find that there are performers who will come into the country and maybe carry out a show. You'll find a musician who will come and get paid, and they'll carry out a show for a day or 2 days and go back to their country. So in terms of residency, they've not qualified. However, the income they're being paid has been accrued in Kenya. It was generated in Kenya. It was earned in Kenya or derived from Kenya, and therefore that income becomes taxable in Kenya. So you'll find where you're residents, they'll tax your worldwide income. So that means the income you've generated in Kenya and the income you've generated from other jurisdictions. So if you're called to perform or to carry out an activity in another country, then the income that will have generated in Kenya plus the income you generated in those other countries becomes taxable in Kenya. However, for non-residents, the income that will be taxable in Kenya will be the income they generated here. So that becomes a very important thing to always remember. Now, income includes any gain or profit from any business, any employment or service rendered, or any right granted for the use or occupation of any property. So in short, in determination of your income, if it will be looking at certain activities. So are you running a business? Are you employed? Are you offering a service at a fee? Or are you also letting out property or granting rights to access or use of your property? Now, initially, in the case of determination of income, now business would be classified as an activity you carry on a frequent basis, probably very regularly. There's an aspect of repetition to it. There's an aspect of profit. So there's an aspect of you're doing it for the profit. And sometimes you may find it may not be considered to be very active, but because of the value that the value of the project or the value of the activity you're carrying out, then you're considered to be in a business. But mostly we look at the aspect of repetition. So you're doing it over and over. If you songs, you're generating songs or writing songs and producing songs frequently. If it is videos which you're putting up, if it is whatever form of content, you're creating it frequently with an aim of getting a profit, then you're considered to be in business. So if you make one video which then generates a bit of income for you and you do not generate anything else in that year, then you cannot be said to be in business. But if you're now actively participating in it, then you'll be told, or you'll be considered to be someone who is in business or in active self-employment. Now, where in employment, in many cases you find that there is the employer and you on the receiving end as the employee, or you as employer and the other parties as employees who respond to you. Now, for it to qualify as an employment, there must be several things. First, an agreement between the employer and the employee on the tax to be carried out. The employer will provide the employee with the equipment they need to execute the assignment, and then the employee will execute the assignment, and the employer will be required to pay. In the case of a consultancy or service rendered, the employer, or rather the client, does not have a control as to what assignments the consultant will take. So the consultant has a choice of saying, yes, I'll do this, or no, I will not do this assignment. Maybe it does not tie up properly with my brand. You understand? So you get that liberty of choosing the assignments you want to do. You're given liberty on how you're going to execute them. And you find that after you execute the assignment and you're paid, then the agreement is terminated. And there is no expectation that you will continue to offer the service. As opposed to the case of an employee, there is an expectation that I'll continue to give you work, you'll continue doing the work, and I'll continue to pay you. Okay? Now, when we talk about any rights granted, what we are trying to refer to here is income generated either from rent or royalties. So then in those instances where then you find that you give out rights to other parties to be able to use your property. So if you have generated a song, then it's probably put on YouTube or on other platforms that people are using. Then they pay to listen, pay to play it, maybe especially in business environment, then they are paying a royalty. The fees they pay is generally a royalty, and that is what then generates your income. So that income becomes taxable. Now, that is now income from active business or active creation. However, there is income that you generate from investments, which include dividends and interest. We may not discuss much of that today. And then we have also got income that you generate from savings for old age, or rather pension. So when you put money aside for you to get to use at a later date as pension, then there are some laws that govern the taxation of pension. And therefore, those are some of the things that become important to be aware of. Now, the law clearly states that where if you're running a business, the gains or profits of a business carried on in Kenya by a resident person shall be taxable in Kenya. Now, how this has been structured is such that if you have registered a company or a business name or a sole proprietorship in Kenya, then you pay your taxes in Kenya. There are instances where the institution is operating in Kenya as a branch. The portion of the income generated in Kenya is also taxable in Kenya. And therefore, what would be of concern would be, how do we get to determine what income is taxable? Because we know there are costs that we incur in generating this income. If, for instance, I am producing a song, first I will take time to write the song. I will go to a producer, a music producer, who will help me to put a tune to it, and until I'm satisfied, then get to a videographer who will help me to prepare a suitable video to match the song. In the process, I will have bought clothes, I will have incurred several costs to be able to make this product available. So I cannot possibly pay tax on all the income I receive. The law allows me to recover expenses that are incurred in making this income. Now, the catch about the expenses that are permissible as deductible would be that these expenses must be wholly and exclusively used in the generation of the business income. So an example would be, if I buy clothes, I buy maybe one set or two sets of clothes I'm going to use when I'm shooting the video. And in the meantime, I also buy another three clothes, which I don't use in the video. So the question is it wholly and exclusively used in the generation of business income? You'll find that in that case, then I'll have to apportion my costs. What I bought for the purpose of generating the video, I will book as a business expense. I will recover that from my revenue. However, the rest is not wholly and exclusively used, and therefore I cannot be able to claim it back. Another common occurrence usually is you have children who are going to school, and so in your business, you remove or you deduct or make payments directly from the business to their school for school fees. So the question is the education wholly and exclusively used in the generation of business income? And if the answer to that is no, then you find that the law will require you then to adjust your profits, to adjust your gains by that much, so that then you only pay tax before you spend. Okay, that's the whole idea. So you find that some of the exclusions, as I've been mentioned, is first, expenses not wholly and exclusively used in the generation of business income. And secondly, expenses that are of a capital nature. an expense is of a capital nature if that item is expected to be used for a period more than 12 months. So I'll give an example. I am a producer and I buy cameras. The cameras I bought might be very expensive. In some instances, even more than $1 million shillings. I cannot book the entire million as an expense. However, I will capitalize the item. I'll put it as part of my assets, my camera, and then I will charge depreciation to it. Now, the depreciation I charge is then going to be treated as the expense. So I will spend it in small portions until I get to recover the entire value of the cost of that asset that I bought. So where you find that the expenditure is of a capital nature, then the expectation is that you're not going to include it in the determination of your income in that particular year. And as you'll see in the example, that there are several adjustments that the law or the government or the VAT Act prescribes, or the Income Tax Act prescribes, for you to be able to determine the tax that you ought to pay. Okay. Now, one very important thing is that, and this cuts across board, is that if you're going to be using these expenses or to deduct that and to arrive at the tax payable, then all these expenses must be supported. This simply means you need to keep receipts, you need to keep records of payments, records, whatever form of record that you have. So if they can be able to raise an invoice, the better. If they are not able to do that, then you can be able to write down on maybe a petty cash or a document showing that I actually spent this amount of money to do A, B, C, and D. Okay, so that then when you're charging that expense against the income you generate, then you find that it is permissible in law. Where expenses are not supported, then you find that the taxman will try and squeeze you out of income. So many times they'll say the permissible expenses will be maybe up to 40%. The rest will be taxable. And yet you may find that in some many instances that your costs are way higher than the income that you generate in the past year. So always have that in the back of your mind. Now, when you're discussing income from employment, this is a situation where for one reason or another, you are employed or you have employed others. Now, the tax payable is determined by the amount that has been agreed upon at the time of employment or at the time when the service was rendered. Okay. Now, this becomes a very critical part because according to the law, there is no particular limitation as to the amount of income to be paid. In fact, how the law has been drafted is that the starting point in determining what tax would be payable would be the amount that you agreed upon on your contract, either verbal or written. So you agreed, we will pay you 100,000 shillings every month. Now, in determining what is going to be taxed, then you find that they will include any form of additional income you generate because of the relationship with the employer. So, for example, you already have your salary. So if you're given a bonus, it will be added to your pay in determining what amount is taxable. If they're going to give you an allowance, maybe for traveling, entertainment, gratuity, any form of income that you're going to generate from that relationship becomes taxable. It's added onto your basic pay or the amount that you had agreed in your contract. All right. Now, that's the initial stage. They go further to look at the benefits that you draw from the relationship between the employer and yourself, the benefits that you draw in kind. So if the employer is going to give you a car which you use over and above working hours, then you're deemed to have drawn a benefit. If they're going to give you a house, if they're going to provide you with airtime, if they're going to provide you with food, any form of benefit that you draw over and above, then it forms part of your income. So it becomes very important, as probably as an employer, and especially to employers, that you are able to tabulate and quantify all these benefits that the employees draw. Okay, in the case of an employee, maybe the question would be, what benefits can I get in another form that is not taxable? So I'll give an example. Instead of you being given an office car which you use, if you can use your personal car and claim mileage, it goes a long way in ensuring that you keep your taxes low. All right. Now, the discussion that we've had is a situation where the employee is employed in Kenya. Okay, he's a Kenyan resident and has been employed in Kenya and is executing the services in Kenya and in some instances even out of the country. Then all that income is taxable in Kenya. That's a case of a resident. But in the case of an unresident, their income, employment income, becomes taxable in Kenya, where because of the nature of the activity they're executing for the employer, they have created what we call a permanent establishment. So a permanent establishment would be maybe a site where you execute a service, or a place where you spend, actually, ideally, if you're in the country maybe for 6 months or more, executing a particular task, then you're considered to be, in as much as you're not an employee of Kenya, then your employment income will be taxable in Kenya because your employer has created a permanent establishment. So as regards employment income, you need to have in the back of your mind that you're not limited to the amount of the contract. In determination of tax, they will look at the amount of the contract and look at all the cash benefits you're drawing and also all the benefits you draw in kind. Now, in the determination of income from the use of property, as I mentioned earlier, you find that the gains and profit will include the rent you draw. So if you have got rental property, the rent you draw is going to be determined as your gain or profit. If you have got properties which you have registered, so for probably you have a patent, you have a copyright, or you have a trademark, which then is let out to other people to utilize, the income you generate from that is called a royalty. And the royalty is subject to tax. Now, you'll discover that as we discuss a little bit, I think it should be in the next slide, that royalties actually attract withholding tax. And the rate of withholding tax on royalties is 5%. However, that 5% is not final tax. Okay. It is a tax paid in advance, which means at the end of the period, you will be required by law to account for your total income, deduct all expenses, arrive at the taxable amount, then reduce the tax payable by the withholding tax that was paid. Now, withholding tax generally is an advance tax. This simply means this is tax which is paid now, but will be accounted for at a later date. So when you offer a service, maybe you perform, go and perform and maybe a tax shield, or go and come up with an activity, either a sporting event and all that, you find that you earn an income. The income you earn is subject to withholding tax. and especially if you're not an employee. So the income is subject to withholding tax because it is performance that is, it is categorized as incomes that are subject to withholding tax. Now, what happens is that at the end of the period, when you prepared your income statement, that income statement is simply your profit and loss, then, and determine the tax payable, then you get to reduce the tax payable by the withholding tax. And some of those incomes include the management, professional, and training fees. It also includes royalties or natural resource income. Natural resource income includes mining, is especially covers mining. So mining of gold, mining of oil, and all that. So you've got interests and deemed interests. You've got the use of property. This is mostly rent. An appearance at or performance in any place for the purpose of entertaining, instructing, taking part in any sport event or otherwise diverting an audience, and then an activity by way of supporting, assisting, or arranging an appearance of a performance. So if you are an event planner and all that, then your category of income is also subject to withholding tax. The recent addition to this, but for non-residents, is if you're participating in self-promotion, marketing, advertising, or transportation of goods, but excluding air and shipping transport services. Now, this is purely for non-residents. So you can participate in these activities as a resident, but as a non-resident, if you're going to procure these services from a non-resident, you'll be required by law to withhold tax and remit. Now, you'll notice that in many instances, even when a person is not a resident in Kenya, there is still a requirement on you as the resident who procures their services to deduct and remit taxes. And the whole idea around this is tax law is usually limited to jurisdictions. So you'll find it's applicable, for example, in Kenya and to residents of Kenya. The tax rates and the tax laws applicable in Kenya will not be applicable on a non-resident Uganda, will not be applicable on any other person. So there's that limitation. And so the government seeks ways to make sure that they have generated as much income as possible, okay, before you release the amount to those non-residents. And so you'll find that first and foremost, the rate of tax will be higher. And why it is higher is because, or to allow, or to ensure that they have generated as much or collected as much as possible. Because once the income leaves this country, they will not be having any taxing rates. This also happens to performers who go and perform outside the country. So you're invited to Tanzania to go and perform. And when you're there and they're paying you, you'll find that you'll have agreed X amount, but they'll pay you Y, having deducted some taxes. Those taxes are applicable as a result of how their law has been structured. But now when you come back to Kenya, seeing that some of those taxes have already been deducted and remitted, then what you need to also ask them for is proof of remittance. Okay, so they were paying you 5 million, they paid you 4.5, then they need to give you proof that they remitted the 500,000 to the revenue authority in their country. And that creates a basis as to how you're going to then determine and compute the taxes locally. Okay, so locally, you'll ideally be required to pay all the tax or declare all the tax. However, present proof that part of the income that you have generated, tax has already been paid in another jurisdiction. And therefore, the revenue authority should accord you a tax credit. It's not as straightforward because they have to recompute and see. Now, in some instances, you find that you paid less tax than if that income was generated in Kenya. Then in that case, they will raise an additional tax demand. However, in some instances, you also find that you paid more tax than what you would have paid in Kenya. The ideal situation is that the revenue authority should refund you that amount. But you'll find maybe in Kenya, that may not be the case. Okay. Now, so now we get into the juiciest part of our discussion, which is now the filing returns. And for you to be able to successfully file returns, there are certain things you need. And first and foremost is set of accounts. And we're saying set of accounts, you're talking about the profit and loss, and you're talking about the balance sheet. That you must be able to have these documents, either as an individual or as a company. Now, the individuals I'm talking about here are sole proprietors or those who participate in partnerships. Okay, if you are an employee, then what you'll require to present is the P9. The P9 is a record showing all the income you've generated or earned in the year and all the deductions that have gone in. So the amount that was contributed to pension, the amount that was given to you as a personal relief, the amount that you already paid to the Kenya Revenue Authority as taxes. So you need to have that document. That document is given to you by the employer. In any other case, you'll require to have a set of accounts and a balance sheet. Another thing you'll need to have is withholding tax certificates for those who have offered professional services and withholding tax has been deducted and remitted to the Revenue Authority. Now, once you have those documents, then you will go ahead to file your return. Now, I hope we can all see the Excel. Let me try and make this more legible. So what I have here is a sample of the profit and loss account or statement. So it's relating to Creative Business Limited, and this is the profit and loss P&L statement. It will have a record of your income. So this is the total income you have generated in that year, in 2021. So there is a portion where you have generated income from consulting income, and you've also generated income from royalties. Now, all this will be added up together, okay, to determine your net revenue. Now, remember, in the case maybe of royalties or in even consulting income, there's a likelihood that withholding tax was deducted and remitted. The amount we'll declare here will be 100%. We'll not declare the amount we earned less withholding tax. We'll declare 100% of the income we earned. Then we are going to have expenses that we incurred. And we don't have any cost of goods sold because we are assuming that this was a case of production of a service. And so we'll have an amount we spent on promotion, an amount we spent on depreciation, bad debts, insurance, maintenance. All these amounts will be added, will be deducted from the sales to arrive at a earnings before interest. Then we deduct our interest expense and we have our profit before tax. Now, from the accounting side of things, the expectation would be that the tax would be 30% of for the 1 million, the earnings before tax. However, from a tax perspective, the computations are slightly different. So for Creative Business Limited, your starting point then will be the 1 million, which was your earnings before tax. That is where you start, or your net profit. So you'll start off there and you'll make adjustments. The adjustments we are making are for items which are not wholly and exclusively used in the generation of business income. And so you find school fees for the children was not wholly and exclusively used in the generation of business income. And so it's added back to our profit, making our profit higher. We also have golf club subscriptions. It will be added because they were not wholly and exclusively used in the generation of business income. Now you've got provision for bad debts. This is an assumption you make, and this you find, especially in the last year, especially, you find that it was a very common position for many companies that they made certain supplies, but because of how the downturn and the effects of COVID, there was a likelihood that they will not get paid. Okay, and in that instance, then they make provisions for those bad debts. Okay, you generated or took some services to offered services to an institution. Maybe you went to a club to perform, and the club was supposed to pay you, but as immediately COVID was announced and there was a closure, then you could not generate you could not get back that payment. And you're not sure when they'll open, you're not sure if they'll be able to pay you. Therefore, you make a provision in your books for that bad debt. Now, from the taxman's point of view, they say, because this is an assumption, this is a general assumption that this amount will not be paid, you will add it back in full and it will become taxable. However, we will allow what you are sure, 100% sure, that you are not able to collect in regards to bad debt. That means it must be specific. You know, it is business X, which owed us 50,000 shillings. We have tried to follow up for this payment. We have written, we have used lawyers, we have used auctioneers, we have gone to court, and nothing is forthcoming. And you have got evidence showing or supporting that position. Then you are allowed to deduct it as a bad debt expense. Okay, now, where the director, for one reason or another, deducts money from the business before paying tax. So you maybe go for a trip to Dubai and the business pays, and it's non-official, so this is a vacation. Or you do shopping for your house, or whatever other expenditure. Then those drawings are added back to the profit. The ideal position is that you pay yourself a salary, pay tax on the salary, and then spend as you please. Or pay tax on the business, and then from the profits, you spend. Now, when you're discussing about paying tax on the business and spending, we are discussing a situation where it's a sole proprietorship or a partnership. However, where it's a limited company, you need to pay tax also as an employee. Okay, so you find that any amount that was spent on anything that was not official and it did not have an impact on the business, it will be added back. Now, you may wonder why depreciation is added back. And a simple explanation is, it is put back so that a unified amount is deducted. And when I say unified, I say it's an amount stated and provided for in law. Now, the example I'll give at the bottom here maybe will guide us better. You buy a car, maybe to carry your equipment, and the car costs you 1.2 million. But because the equipment is not heavy and you think you'll be in this business for a long time, you start depreciating the car at the rate of 10%. That means you're planning to keep that car for a period of 10 years. So your depreciation on the car will be 120,000. Now, you also buy furniture because you set up an office. So you buy furniture and you expect to use this furniture for a period of 20 years before you change. And therefore, you depreciate the furniture at 5%. So 5% of 300,000 is 15, and 10% of 1.2 million is 120,000. Now, if you sum up the 120 and the 15,000, it gives you 135,000, which was a depreciation. So the depreciation is added back. Now, why is it added back? Because someone else would buy a similar car, assuming it was a Nissan you bought. Someone else will buy a Nissan and put it as a company or a tour van, or use it to carry heavy goods for deliveries every day. So you find the rate of depreciation they're going to use based on their own opinion on how they run the business will be different. Someone else will think they'll only keep that car for 2 or 3 years, while someone else in their accounting foresees a situation where they're going to keep this vehicle for even 5 or maybe 10 or another 20 years. So you find that the rates for depreciation will vary. And as a result, then the amount of depreciation will vary. And therefore, the tax paid will not be equal as a result. And therefore, what the taxman has done is that they proposed what we call wear and tear rates. Under class 1 of wear and tear, we have got items of a particular nature. So we've got heavy earth moving equipment, we've got all motor vehicles, we have computers and computer peripherals, we have softwares, calculators, filming equipment produced locally by licensed film producers. You'll find all these items will fall under class 1. Now, class 1 prescribes this, that the wear and tear rate will be 25%. Now, since we bought a motor vehicle, 25% of the motor vehicle will be 300,000. That is the wear and tear from the motor vehicle. Then in class 4, we've got furniture and fittings, we've got telecommunication, equipment, other machinery, rights to use over fiber optic cable. Then these ones will be subject to wear and tear at the rate of 10%. So it does not matter which industry, it does not matter who bought them. The rate applicable is standard. It's unison, it's uniform for all, as long as the item meets the criteria. And therefore, 10% of 300,000 will be 30,000. Now, the 330 is a summation of 300 plus 30, giving us 330. And therefore, you'll find in our computation for tax that the amount deducted, we added back 135, then we deduct 330, the unified amount. So you find that whereas your profit before tax was 1 million, the amount that is being brought to tax is higher than the amount that you had computed in your profit and loss. Okay, there are instances where the amount becomes lower. Okay, so we had 1 million as profit before tax, then the taxable amount goes maybe to 900,000, 800,000, 500,000. In some instances, no tax to pay. Okay, so it depends. So it's very important for you to keep these records. For you to arrive at this computation, what will support this is the records that you have kept. It is very important. Now, to also prepare these financial statements, the income statements, the balance sheet, and everything else, you need assistance. You need assistance of an accountant who should be able to assist you to arrive at this. Okay, so it's very important that you also have that in the back of your mind. So you find then, in that case, the tax payable on the 1.4 is 439,500. However, assuming from the consultancy and the royalty fees, 100,000 had been deducted as withholding tax. So maybe part of the income was subjected to withholding tax, while the rest was not. So 100,000 was subjected to withholding tax. Then what you end up paying as tax, because 100,000 has already been paid to KRA, will be 439,500. This is the amount that you'll pay at the end of the period. So then the other question comes about is, then how do you get to file your return? And that's what I like us to go through now, so that we can get to see how to submit that return. Okay, we'll start off. So where we start off is by logging onto your iTax page. I hope you're able to see the iTax page. So this is my personal one. And so you'll put in your password and you log in. This is how the homepage looks. So where you start off by going is to the option of file return. Now there are two kinds of return you can submit. The first one is a nil return. You only submit a nil return where you are sure you have not generated any income in that financial period. Okay. That is the only time you file a nil return. The financial period for individuals runs from January to December. Okay. For companies, it varies, but you need to file your return latest 6 months after the end of your financial year. So the financial year 2021 for individuals ends on the 31st of December 2021. So by the 30th of June 2022, I need to have filed my income tax returns. So the first option is filing a nil return, but you only file a nil return if you did not have any income coming to you. Okay. So, and to file a nil return, you just click, and then you'll click on the tab File Nil Return. It will lead you to the page where you will then select which kind of return you want to file. So you either in resident individual, non-resident individual, or rental income. So in our case, it will be resident individual. Then you'll click next, and then you'll indicate the period. Now it cannot agree because we've not completed 2021, and therefore I cannot submit a nil return. Okay. For companies, the procedure would be the same. So you select the first option, file return. Then you'll select the kind of return you want to submit, which is income tax, resident individual. And then when you click next, it will take you to this page. On this page, you will download the Excel. There is an Excel that is system generated, that is used in the submission of the return. Now, what you need to do after that, I need to show you how the Excel looks like. So allow me, I will open it. So it looks like this. I hope you are all able to see the Excel. Now, the first thing that you'll indicate on your Excel is your personal identification number. That number is your PIN number. Your PIN number. That would be the first thing that you indicate on the return. Secondly, you'll be required to declare what kind of a return you're submitting. So there are usually two kinds. It's either an original return or an amended return. Okay, and in this case, since you're filing 2021, it will be original return. Then we'll indicate the period. So we are filing the return from the 1st of January 2021 to the 31st of December. Okay. And then we'll also need to answer the questions that follow. So like, do you have any income other than employment income? And if you're running a sole proprietorship, your response to that should be yes. And when you respond and say yes, then it will automatically the system will automatically generate additional sheets. The additional sheets will be the profit and loss, the balance sheet, and the other sheets which need to be filled. Now, as soon as this opens, I'll be able to show you how we get to fill those sheets out. And arrive at the tax payable. So as you can see, I'm filling out the Excel sheet to indicate the period which I want to file the return for. So you'll indicate the start period to the end period. Then the other information which you'll also need. So I'll use today's date for the purposes of this illustration, yeah? And what I'll need to declare, or yesterday's date, sorry. What I need to declare is that I'm also declaring business income. Okay, and you'll notice that it has generated additional sheets, which includes the profit and loss, the balance sheet, stocks analysis, this is ID claims, and other things. But the basic information becomes very important because this is where a lot of the things are determined. Now, when you are filing a return, it's also important to declare the nature of your income. In this case, they're asking if it's partnership income. If it is, then you say yes, it generates sheets for you to submit partnership returns. If it's estate return, it will give you the option to file all that. Now, if the employer has given you a motor vehicle, then you get to fill out this part and say yes. Then it gives you the option to fill out the details of the car and the system will compute the tax payable. If you have a mortgage, there is a relief for individuals on mortgage. So you have the option of declaring this as well. If you're contributing to a home ownership saving plan, this was discontinued and therefore may not be of assistance to you at the moment. If you've got life insurance, then you need to click yes and leave the details of your insurance policy. If you have a commercial vehicle includes an Uber, it includes a truck, it includes any vehicle that is given for ferrying people and ferrying goods. Then you also fill out this space and there are returns, that information that you need to provide. The other question would be, would you earn any income from a foreign company? And here you need to declare either yes or no, depending on where your sources of income are. So if you say yes, it will automatically generate additional sheets for you, which will be required to fill and to show whether taxes have been paid. The other question is, have you been issued with an exemption certificate? Now, the common exemption that is available for individuals is the exemption of disabled people. They're given an exemption so that the first 150,000 shillings they earn in a month is not taxable. They also get additional exemptions. So for instance, they can bring in equipment or vehicles, for instance, that have been made to suit their needs. And in that case, you do not pay any duty on those vehicles, in as long as they've been made to fit your purpose. So maybe whatever reason it may be, the vehicle has been adjusted to suit that purpose. The other thing is that you may find out other riders, small riders, they may not pay parking in town, and all those things. They're also allowed to deduct up to 50,000 in expenses that they use on medication, so, or medical equipment. So when they're buying wheelchairs or they're buying crutches and all that, then they are entitled to that exemption. Now, when you're employed only, so you will not have any other income. So in your return, you'll declare the details of the P9 on this sheet. So you'll have the PIN of the employer, the name of the employer, the gross pay, and then any allowances and benefits that you get. Okay, you'll get to fill out that data here. Then on the next sheet, you'll have details of the taxes deducted. So you'll still have the name of the PIN and name of the employer, sorry, taxable salary, the tax payable, the amount of tax deducted, and the difference will be the personal relief. That is what is going to remain on the grade area here, but you'll be able to fill out the other information. And after that, then you can go to the tax computation. On the tax computation, you'll include the NSSF that you contribute. Generally in a year should be around 200. So by 12 is 2,400. And then there is also the personal relief, which currently is 2,400 by 12, which will be 28,800. Then, if you had any withholding tax which had been deducted, withholding tax certificate, this is where you're going to come and put it. So, for instance, from our example, we had 100,000 withholding tax that had already been deducted. The minute you indicate it here on the Excel, you see the impact is that it creates a situation where it gives you a credit which you're going to utilize against the taxes payable. But you'll notice that it cannot work if your income is only from employment. So that means you must declare business income and get to declare the total income. I think that's why it's behaving the way it is. But anyway, so you get a feel of how you're going to declare that income. Now, when you're submitting your return, you will duplicate or copy the information. You'll copy the information from your annual income statement. So you'll have consulting income, you'll have royalty income. On the Excel, you'll have under advertising and promotion, you'll put that amount, under depreciation, that amount, and you'll keep filling out so that it matches the profit and loss in this return. The profit and loss in this return should match the profit and loss that you have in your statement. So you'll find there's consulting income and royalties, you'll sum up and put here. Then you'll have on this, you have got other incomes. If you're generating any other income, maybe a dividend and all that, maybe you'll declare it. Then you have got now the expenses. Advertisement will come here. Any expenses on computers you'll indicate. But remember, the taxes are usually separated so that you pay tax based on the source of the income. So they separate the sources of income. So business income is accounted for separately from farming, separately from rental, and separately from interest and commissions. And the whole idea is so that if one line is profitable, if, for instance, your rental, from rent, you've got tax payable, you pay tax on rent, then if you had a loss under business, you carry forward the loss to be utilized in the next financial year. Okay, so they allow you to separate. Now, I think up to that point, I have covered that. Now, maybe things that you may need to remember is that as regards returns and filing taxes, you need to get qualified advice. This information, the system of taxation in Kenya is such that you declare the information. You give the revenue authority information. And therefore, you need to give them accurate information right from the onset. It's very difficult to try and say that the taxes that are declared were wrong. The correct taxes should be lower. So for instance, if you declared 1 million, it's very hard for you to come and reduce it to say that the tax payable is 500,000. However, it's very easy to increase. So if you are declared 500, it's very easy to push it to 1 million. The most important thing is that get your information accurate right from the onset. And how do you do that? Is by getting qualified advice. The other thing is learn your business tax liability. So understand your business. How are you operating? If you're operating as an individual, is it a sole proprietorship? Is it a partnership? Is it a limited company? Just find a place where you can say, I am comfortable in this. My advice would be many times try and register a business that is separate from you. When you register a company takes up the liabilities, can be sued, can sue, can own property, can do all these things. So it becomes a person other than yourself. Even when you're planning maybe your estate and all that, if you put property under the company, then it becomes easy to transfer, easy to have things continuing. However, if for one reason or another, you're not available and you're running a sole proprietorship, then the sole proprietorship goes with you. If you die today, then it's no longer in existence. So it's very important that you learn and see what vehicle will suit me the best. But you also get to just understand where am I currently and what are the tax requirements in the space that I am operating. Now, set money aside for taxes. Once you have determined and you know tax payable, or you assuming how you can, easy way to work it out is I have earned 1 million shillings. Therefore, I will put away 30% of that in an account which I cannot touch for tax. Then, after I've paid tax, whatever surpluses remain, then I can use. But always have money set aside for taxes. That helps in ensuring that you do not accrue penalties and interest. When taxes fall due, you're able to pay. And number two, you do not also land yourselves in problems with the revenue authority. Then, if possible, have an accounting system that can help you to track and place income and expenses in the correct position and give you an overview of your activities so that you know whether you're profitable or not, whether you're generating an income or not. Because you may find you've signed one contract of 3 million and you've gone 6 months without business. Your expenses are way above the 3 million. Therefore, you find that you're not in a profitable position. You need to always be on top of your game. So try and get that accounting. It could be an Excel sheet. It could be a system, maybe QuickBooks or something, but something that can help you to keep track of your income and your expenses. And then get an accountant. As I go back to getting qualified advice, get an accountant to help you manage your business. I think I'd like to leave this open now for question and answers.
Wow. Thank you very much, Evans, for that. I mean, it's always such a big challenge. That's why we have to work with experts because, you are the ones who get to get the numbers and so on. It's so much work. You can imagine a musician or a filmmaker
Yes.
trying to go through all those numbers. It can be really, really difficult.
Yes.
Just a quick one. So supposing um, I because the withholding tax is paid in advance. Supposing at the end of it all, the expected amount that was withheld, the withheld amount was more than what I should actually have paid, because it's paid in advance. Can I make a claim to get this money back? I mean, and also, how do I get to know that actually the withholding tax was remitted? So it is deducted from my royalty, so I can see it is deducted from my royalty, but was it actually delivered? Was it actually paid on the other side? So those two questions, and also if you could just make a comment on the capital gain tax, just again very briefly, because some of these guys are also buying and selling things.
All right. So when withholding tax is deducted from your pay, the only proof that you have that it has been paid to the Revenue Authority is when you receive a certificate. And the certificate you receive will be a withholding tax certificate. It's system generated and it is sent directly to your email address. So if you have not received that certificate and money was deducted, then you have got a right to walk back to that client and ask them to either pay you the money or to remit it to the Revenue Authority. Okay, so it's so important that you have that in the back of your mind. If anyone deducts money and says this is tax that is going to be remitted to KRA, then you ought to receive a certificate, be it VAT or be it withholding tax. The other thing, where you find that the amount that was deducted is higher than the amount that you are supposed to pay at the end of the period. First and foremost, you don't pay anything at the end of the period. Secondly, you have got room to apply for a refund. And that is why, and that is where audited statements or statements of account become very important, because then you're able to provide supporting documentation to support the accounts you have, and KRA can review and issue you with a refund. The only challenge with KRA is that at the moment when you're making the refund, they will try and find other mistakes in your accounting or in prior periods, just to make sure that they don't pay you. And if they do, they don't pay you the whole amount. So you need to have that in the back of your mind. But if you kept your records properly, the expenses that you're claiming are wholly and exclusively used in the generation of business income, then that should not worry you. You should just present the documentation and they should be able to issue you with the refund. Now, maybe I could mention this before I mention capital gains tax. There are instances where you find you have expenses that are shared. Okay, so you buy internet, and since you're working from home, you're using internet in the house and also using it for the business. You're working from home, you're paying rent at home. And so the rent you pay is shared for home and office. So the most important thing is to find a way of apportioning. Okay, so you could apportion based on the space you've occupied or based on the time that you have spent. But the most accurate way would be by the space occupied. So maybe you've taken up a 3-bedroom house where you use 2 bedrooms and the sitting room and all that as your dwelling area, and the 1 room you're using as your home office. So from your rent, you could find a way of apportioning the rent so that that portion that relates to that office is treated as a business expense, whereas the rest is your personal expense. So that becomes very important. Now, with regards to capital gains tax, this tax is payable on immovable property. Movable property will generally be land and houses. So where you're transacting in land and houses, you need to be aware there is an aspect of capital gains tax. Now, if I am selling land to person X, the responsibility to pay the capital gains tax will be on me. If I bought the land at 100,000, I'm now selling it at 500,000. I will need to deduct expenses which I incurred from the gain of 400,000. I'll deduct the expenses I incurred to bringing this property to that value. So if I did any fencing, I will deduct the cost of the fencing. If I had to incur maybe some legal costs, whatever cost, maybe you sunk a borehole and all that, all these costs you get to recover first. Then on the surplus you have, you pay capital gains tax. The rate of capital gains tax is 5%. The good thing is that that is final tax. Now, if you're transferring this property to your wife or to your husband or to your children or to a company that you are owning 100%, so you own the land and you also own the company, then those transactions are exempt from capital gains tax. Even in cases of divorce, where you are transferring property from yourself, maybe to your spouse, then you find as a result of divorce, it is exempt from capital gains tax. So maybe that's what I could mention with regards to capital gains tax at the moment. And you'll find that this tax is actually paid as you're concluding the transaction, the tax is paid. If you're in the process of buying and selling land, that's your business. So you, as a side hustle, you buy land, subdivide, and sell. Then the land you buy and sell does not have capital gains tax. Why? It is part of your stock. The expectation is that you're going to pay tax on your profits. So you sold, you divided, you got 16 plots, you sold 10. Out of the 10, then you deduct the cost, maybe subdivision, employment costs, rent, and everything. The surplus you have is what you pay tax at 30%. So it's very important that you understand that, to differentiate when you're doing it as a business and when you're doing it as an individual. So if you sell land as an individual, a one-off, then there's an aspect of capital gain tax. But if you're doing it as a business, then there's no capital gains tax associated with that. But you end up paying tax at the rate of 30%.
Okay, okay. I got it. I don't know whether there is any additional question. I think you were very, very clear in terms of the various taxes and obligations. Yeah, I can see there is a question from Naftali. He's asking, is there a minimum amount that's not taxable in terms of income tax? That's from Naftali. And thanks, Naftali, for joining us.
All right, thank you very much. Now, the minimum tax, okay, the minimum amount that is not taxable, ideally is 24,000. But it does not mean that it's not taxable. It just means that the tax, and especially for individuals, the tax payable is covered by the personal relief. So the first 24,000 shillings you earn as an individual is taxed at the rate of 10%. But the government, on the other hand, has given you a relief of 2,400. So assuming you earned 24,000, 10% of that is 2,400. And the government is giving you a relief of 2,400. Therefore, there is no tax paid. Okay. However, if you earn anything above 24,000 for an individual, then it becomes taxable. In relation to rental income, the minimum amount that is not taxable in a month is 24,000 shillings. However, again, as I said earlier, it does not mean that it's not taxable. The idea is that that 24,000 needs to be lumped up with other income. So okay, under rental income, there is what we call residential rental income tax. The rate of tax under residential rental income tax is 10%. And that 10% is deducted and remitted every month from the gross receipts. Okay, they put a minimum and a maximum. So the minimum is 24,000 shillings in a month. Now, this 24,000 shillings, then it means if it is not going to be taxed at that rate, okay, the law says that it's not taxable, but in practice, the Revenue Authority still expects you to declare that income. The only challenge is that you may end up getting yourself in a position where you've overpaid taxes. So it's usually advisable. Then you file a nil return under residential rental income, but you declare that income under your income tax and a rental income, so that then the rates then apply. Okay. The only challenge is that if you have got any other income, so maybe you're generating income from your business and you have got rental property, then any other income, because you're only entitled to 2,400 once, then it becomes taxable. If your income exceeds 1,250,000 in a month, okay, then you also cannot deduct tax at 10%. You are supposed to pay tax at the rate of 30%. The equivalent of that in a year is 15 million. So maybe the question would be, how then can you be able to ensure that you maximize? And again, having your property held under the company goes a long way, because then you could have company A holding X number of units and company B holding another X number of units, the total of which would be more than 15 million, but because they are held in separate entities, below 15 million, and therefore you pay tax at 10%. That's a tax planning you can be able to do around rental income.
I mean, I have always thought that Kenyans are overtaxed. I mean, look, I mean, if a young man is earning, say, 40,000 shillings
yes,
in Nairobi, and they are paying rent and they are eating, I mean, they are still subjected to 30% tax in terms of income, in terms of pay, isn't it?
Yes.
Is there no way that they can actually claim some form of? I'm now speaking from a human rights point of view. Is there a way of, of helping such a young person who is a recent graduate earning very little money, to be able even to just make some little money on the side? I mean, to grow. Do you have provision for that in the tax regime?
Unfortunately, the options that we have are not too many. But what would be available, for instance, would be if he can take up maybe life insurance or education policy, then he can get some relief from tax. But you see, now it's tying up his money on a product that maybe he does not want to get the relief. You understand? Or he can contribute to pension. When you make contributions to pension, you're allowed up to 20,000 that is deducted before tax is computed. You can also make contributions to, you can also take up a mortgage. If you have a mortgage, you also get deduct from the taxable amount up to 25,000 in interest. But when you have got low income, okay, I'll just say this: how KRA and how the law has been structured is just to make sure that the government benefits the most. You'll find where you stand to benefit, they'll put a limit as to how much you can benefit. In terms of deduction for pension, you can contribute whatever amount, but the deduction from tax is limited to 20,000. Or you can get a property which you're paying pension, okay? Not pension, you're paying interest. You're paying interest for this property, it's on mortgage. But the interest deduction is limited at 25,000, irrespective of the fact that you might be contributing a lot more. You will be paying a lot more. You will be paying even up to 50,000 in interest. But the only amount you get a relief on is up to 25,000. So that's how they structure the law. And then where they stand to gain, you'll find that they will collect as much as possible. So they say, if you're earning any amount above 32,333,000, then the tax you will pay will be 30%. And that is after COVID. Before COVID, it was much better. Well, it was at 42,000. Not a huge difference, but at least maybe you can say that 3,000 would have created a cushion somewhere. So on one hand, they're giving you a higher relief of 2,400, but they come back and recover it by lowering the tax band and charging you tax at 30% right from 32,000. So you can see it's how it has been structured. Maybe what I could encourage employers then is to consider giving some benefits to them that may not be taxable. So for instance, when I was saying underemployment income, in determining the taxable income, they include any benefits you receive in cash and all benefits you receive in kind. Now, when you're discussing about benefits in kind, the ones that can be able to at least give this individual as some form of relief would be maybe meals, because if provided the meals don't exceed 4,000 shillings, they're not taxable on the employee. Or you can give them maybe airtime in kind. So you load up their phone with airtime, but it has to be below 3,000 shillings. Okay. And when they go out for assignments, you make sure that if they're going out of town, they also get per diem.
Okay, I think that's fair. I can see a set of questions, one from Robert. Robert says, on keeping records, what happens for upcoming creatives who use public means of transport where there is no ETR, such as buses, which amounts to some of their expenses, especially for large groups like bands. Costs like hiring rehearsals and studio spaces that may not have a receipting system. So how will they keep records and evidence? And then from Naftali, there's a question on for content creators, e.g. YouTubers, there is a taxation form, the earning acquired from the United States, while one is filing for taxation. Should such jurisdictions that have already deducted tax be omitted, or this be a case of double taxation? Should one file for taxation only for the money earned from Kenya viewers or for all the money earned globally, regardless of where the amount has been taxed elsewhere? I think that Naftali is also, the question by Naftali relates also to DST, the Digital Service Tax, and the money earned globally. And so maybe you could make a comment about that, and also the question from Robert on a non-receipting system and so on. I mean, I think if you have a band that goes to Mombasa and they don't have receipts, how do they keep records? I think these are reasonable questions, Ivan.
Yes, indeed, they're reasonable questions, and they're actually very good questions. Maybe what I could encourage them to do, I'd encourage Robert to do, or those who use public means, for instance, and or hire rehearsal spaces where they're not given receipts and all, they could have an internal system where they keep records. So you could get a petty cash book, which will document. So this amount was paid to XYZ for transport. Now, if I'm a member of the band and I'm given transport, maybe worth 1,000 shillings for the week, I sign for that 1,000 shillings, that I actually received the 1,000 shillings as money for transport. If I'm paying for space, the person who receives that money, so the owner of the property, comes and signs in our book that we paid him 10,000 shillings for the month to use the space for rehearsal. That way, if they are not able to give you documentation, you create some form of documentation for yourself. Now, this documentation, it has to be, and I insist on this, that mainly has to be authentic. So by you preparing that and having them sign, you create that authenticity, so that if they are approached, they'll say, yes, this is my signature, I'm the one who received this money. Okay, that way then that can be used as a source document in accounting for that money, and I guess it can also be used in supporting in case of a query by the Revenue Authority. So where the person you're interacting with is not in a position to give you documentation, then you are at liberty to create a system internally for yourself to account for this money. Now, over to the next question. Where you have paid tax in the other jurisdiction. Okay, the first question that you need to respond to is, where are you resident? Now, the Kenyan law requires you to declare your income on your worldwide income, as in to declare your worldwide income. That means the income you have generated in Kenya and in other jurisdiction, in as long as you're resident in Kenya. Now, remember residence in Kenya, we said 6 months in a year, that's 181 days, or an average of 121 days in 3 years. So if you have met the residency status, then you need to declare your worldwide income in Kenya. What you also need to present is evidence that you paid tax on this income in those jurisdictions. And therefore, either it can be treated as an expense and reduce the amount which tax will be paid upon, or it can be given back to you as a refund or as a credit. You understand? So make sure that you have the record that you have already paid the tax. So I think I've answered both questions, because I think the second question, yeah, I think I've answered both questions, unless if there's
The public, there was the public transport. So I'm moving to Mombasa with my band.
Yeah, for the public transport, I was saying that they need to have an internal way of accounting for it. So they maybe have a petty cash book, which they sign off. So I was given 1,000 shillings for transport for this week, and I sign off. And that way, you've created a system of tracking that income, showing that it moved from the bank, was given to person X for his transport or as his allowance for the week.
Yeah, I think that's good. We're doing very well. I don't know whether there is any other question which you might want to respond to, but I think that we've covered the ground very, very well. Yeah. So I think let me just bring this meeting to a close. But first of all, thank you, Evans, for a very good, really capacity development on this taxation filing process. I think you really covered very good ground. You have shared with us not just the various taxes that we might be asked, we are required to file, but also taken us through the process of filing. But I mean, I think towards the end, you really did encourage us to seek professional support when we are filing our returns, so that we are also able to claim that which belongs to, that which is ours. So I really want to thank you very, very much. And for those that are attending today, to just also indicate that next week, we do have, on Friday, we have a partnership with Kekobo to discuss Kenya the intellectual property rights issues. And this also building capacity on how to monetize, the creative sector, how we can create money, from the digital platforms that exist, and also the distribution systems that are possible, so that we have a global distribution system for the creative sector, whether it's in music or in writing or in film, whatever, and so on. So I want you just look out for the announcement from our various platforms, and I want to welcome you. It will be same time, 11 a.m. to 1 p.m. Again, working with Kekobo on this one. And I also did mention that we have another event related to the restitution of cultural heritage, which is an opportunity to discuss our cultural heritage that's located in Europe and America. And on Wednesday, we will be on Tuesday, we'll be engaging perspectives from Ethiopia, Nigeria, Tanzania, and Kenya. And also Wednesday, we'll also be looking at other African countries. Again, we believe that cultural heritage is important for creativity, so that when we get access to our resources out there, we are able to create better, because we get points of reference. It is not fair for our people to have to travel to Germany to get inspiration. So we will be discussing these things and we'll get perspectives from other jurisdictions. So I really want to encourage those of you who are in the meeting today to also just turn up for the Tuesday and Wednesday events to get perspectives from the rest of Africa as we build the platform for ratification of conventions that will allow us to get our staff back. So I want to thank you, Evans. Thank you so much. We might be calling on you later if there is a need for additional reflection on filing of taxes as we move forward, or if the sector still needs more clarification. So we might be calling on you in future, but I really want to thank you for today.
Thank you very much. I'll be looking forward to that call, probably to see how we can be able to further build capacity and ensure that people participating in the creative space remain tax compliant and thrive and are not bogged down by the red tape that is in the law, so that once they have the information, they can be able to do a lot more.
Thank you very much.
Thank you very much also for having me. I've enjoyed. It's been an engaging class, and I appreciate the opportunity.
Thank you. Thank you so much. I think that's it for today. So see you next week, guys, and all the best over the weekend. Thank you.
Thank you very much.